Welcome everyone to this wonderful topic of capacity planning. We will be talking about how to build capacities, how to plan for future requirements in this presentations. Right. So capacity planning, what exactly is it all about it? It is defining the upper limit, or should I say the ultimate load that a particular unit can handle. It is the best case scenario that can happen as far as production is concerned. So, can we go about it? The upper limit, the best case scenarios, how do we go around it? So, there are basically three things that you need to keep on answering to understand how to plan for capacity. First and foremost thing is what kind of capacity is needed, what is that we are looking into it, how much is needed, and the time frame thereby. These three questions: what, how, and when. What kind of capacity? Do we plan it for short-term basis, as on when on basis, or do we plan it for a longer term basis? If so, then we need to have enough amount of space around us. How much is needed, and probably when is it needed? We have already said about the time duration that we are planning around. So, impact which comes up with the future demand is the most important factors for capacity decision. Remember, the future demand is what we are looking into. Affecting the operating cost is what we should be doing about. Now, in terms of we have a small operation right now, but future we anticipate things as to going to increase manifold. But does that mean that we should make provisions for future requirement as of today? Because then it means a shorter cash flow and we will be in red. Our balance sheet will be always in red. So please understand it affects the operating cost. Major determinants of initial cost as the money will be talking around it. We are talking about a long-term commitment, competitiveness, and the effective ease of management as the case might say so. So yes, we are talking about the future demand. We are talking about the operating expenses, the initial money that needs to be footed down or paid upfront involves long-term commitment, affects competitiveness, and affects the ease of management as the case might be. So let us talk about the various capacity that can be planned around it. First and foremost thing, what is the maximum output that we need to go around it? I say the best case scenario, and then we need to bring in the variations that comes in it. Not everything can be working 100% all the time. There might be breakages, there might be slippages, things might go wrong on the workforce front, things might go wrong on the finance part, things might go on the technological front. So maximum capacity is subjected to planned and expected variations such as maintenance, coffee break, scheduling conflicts, and so on and so forth. Now, I will definitely elaborate this with an example for your understanding in the subsequent present slides. So, and see, we have design capacity for the maximum output. Then is an effective capacity, what actually happens on a day-to-day basis, keeping all the variations that can be crept in, and the actual output, unexpected variations, and the demand thereof. Now, actual output can differ, can vary. Rarely it is absolutely we go beyond a certain capacity, but probably at random disruption, machine can break down, absenteeism can bring in, material shortages can happen, say money, finances cannot be, uh, finances flow might stop altogether. So there might be certain unexpected variation that comes around it. So we have design capacity, effective capacity, and whatever actual happens around it. Now, these are the two formulas that needs to be discussed, and we will discuss in the subsequent slide. Remember, efficiency is all about actual by effective capacity. What was an actual output and what was an effective? So, not 100% effective. Definitely, it might be 90% effective, of which the actual output might be less than 90%. So, efficiency must be male less altogether. Utilization would be actual output, let's say the actual thing which has happened, and design capacity is always 100%. Remember, that is always 100%. So this definition of efficiency is not very much used. Utilization is more or less important. Let's say, I was talking about giving you an example. Let's say we are talking about 50 trucks a day available for a transport company. That's my design capacity. But is 50 truck available? Effective capacity is always 40 trucks because 10 trucks are always under maintenance for one reason or other reason. We say 40 trucks are effectively available because 20% trucks goes under planned maintenance. But does that mean that 40 trucks are at your disposal and they are always helpful, available for you? Probably no, because in actual thing, only 36 trucks per day is available. Maybe. I am just guessing. I'm just giving you different examples altogether. As in recent, there's three stuck in maintenance delay, or there is a flat with one of the tires, or let's say there are no orders per se for the four trucks. So there are actually 36 trucks. Every truck is absolutely fit and fine, but there are only orders available for 36 trucks to be maneuvered. So that is my actual output. Now, based on the formula that we have discussed in my previous slide, efficiency is about actual output by effective, that is 36 units by 40 units will be 90% of the utilization is there. But when it comes to utilization, remember actual output is only 36 and design was always 50. That means it is effectively 72%. I hope with this elaborate example, everything should be clear for the audience of this video. Now, determinants of effective capacity and output. Number one would be a facilities layout. What are we looking at it as far as layouts are concerned? Are we into products? Are we into services? Because then the capacity has to be designed differently. Are there any product mixes or there are standards product that is available in front? Then comes the processes, as in the qualities of the output that comes around it. We look forward to the processes and the qualities thereby. We are also looking at the motivation or the human consideration of the capacities, of the effective capacities and the out as on when on basis. Now we'll talk about the operations. Yes, it's the scheduling and the synchronizing problem. At times there might be downtime for the machine. At times the workers might not show up. So operation might get hindered around here and there. So this actually relates to your effective capacity vis-a-vis the output. Supply chain factors are the material shortages, raw materials are not available, or in fact, I would say the one, two, three of the raw materials are missing in different proportions, or so on and so forth. External forces might be regulation, might be the laws of the federal government, might be stipulations from the local bodies, governing bodies, and so on and so forth. Caution. So when we are looking into it, capacity is almost synonymous to the output as the case might be. This is what needs to be understood and find out every now and then. So if you look out here, we have possible decline or growth pattern. If you look at this graph, the depiction is like this, right? It's a growth pattern. On the other hand, when the slope is the downward, it will be a decline would be like this. Right. Similarly, there is nothing which is there is no growth nor decline. If you look in this graph, it has been plotted as a more or less straight line. Whereas in this cyclical thing, it goes out here and there, it goes out here and there, and so on. So, what are we looking at it? What are we looking at it? We are looking at production volume on the y-axis and the duration that goes around. If a company is doing good, it is on the right track. There might be some anomalies, but eventually the trend is up. There might be some uptrend, but eventually the trend is down. So you need to understand. And then there is something called cyclical in nature of the business, which is going ups and down at a regular interval. Obviously, with the stable pattern, almost everything is more or less same coming around it. So designing or developing alternatives, how do we go around it? First and foremost is to be modular expensive. Take a big picture. Approach to the capacity changes: hotel rooms, car parks, restaurant seats, you name it. You are looking at capacity alternatives. So if we have big chairs in aeroplanes, can we reduce the width of the chair and increase, cramp in one more chair into it? That means another tickets, another seats, another revenue model. If the hotel rooms can be made a little smaller, we can pull in one, two, three extra rooms for every floor that we are planning it around. And it might be a very small hotel that I'm talking about. In case if it is a big hotel, we can add in up to 10, 15 rooms altogether, just making the room a little bit smaller. Parking area, missing on the car parking area, going for a public utility, restaurant seat, and so on and so forth. Now, they differentiate. Now, this is where you need to understand between what is being launched as a new product and what is a product which is already accepted and widely acknowledged by the public as a mature product. Pay attention to the life cycle, demand variability, and discontinuation as on when on basis. So you need to understand the product life cycle and introduce new products so as to keep your customer hooked onto your services and products. Prepare a deal with the capacity chunks. No machine can comes with the continuous capacity as the case might be. This is what we are looking forward every now and then. Attempt to smooth out capacity requirement. Complementary product subcontracting is another way to reduce your cost. It is the word would be outsourcing around it. To smooth out your capacity requirement, you don't have the capacity to can be outsourced to the vendors altogether. That is what is known as subcontracting. And last but not the least would be optimal operating level as far as facility circles are concerned, facility size is concerned, and so on and so forth. So one of the decisions that comes around here, I have already said about is outsourcing. Outsourcing is something wherein we need to decide that we are producing a product or a part of a product, or let me be very specific as a component of a product. Can it be outsourced altogether, because the economies of scale for the outsourced vendor will be much easier for them, and it will be profitable for them also and for us also. So should it be a make decision, or should we make a buy decision? Should it be outsourced, or should we manufacture it in-house? So outsourcing is obtaining a good or services from the external provider, in this case the vendor or the supplier. Deciding on the outsource by considering available capacities, expertise, quality consideration, the nature of demand, stability, cost, risk, loss of control over operation with outsourcing, loss of know-how and loss of revenue as the case might be. This is what the risk is all about it as far as loss is concerned. What cross. Now, if we have an evaluating alternative facility size, production units have to be have an optimal rate of output for minimal cost. Now, what are we looking out here? On the y-axis is your cost factors and average cost per unit. On the other hand is the rate of output, the number of things being produced. And if you look into it, the production average cost will actually go down in this first place, and then it will plateau out up to a point, and then it will start escalating and this in this phase. So this is what the production cost is all about it. Once you increase the number, so what is my optimal level? This is my optimal cost which goes around it. At this number, I can produce maximum number of products and the least amount of cost, or economics order altogether. Similarly, evaluating alternative for facility size, we need to keep on evaluating. For a small plant, number of product is very less. For a medium plant, the number of product gets less. The cost get further hammered down. But a very large part, you can have a lot of number of products, and further the cost price has been averaged down or hammered down altogether. So we need to evaluate this one by one. So let us understand how to plan the service capacity. Should we be at the consumption pattern end, where there is an influx of customers, or should we be located at the uh, near the sources of raw material? This is what we need to go around it. So need to be near the customers, as in location to be closely tied, or inability to store services capacity must be matched with timing of the demand. And last but not the least would be the degree of volatility of demand as the case might be. Remember, servicing is all about producing and consuming at the same time. So we need to be near to the customers. Definitely, yes. We cannot store our services. It is being consumed as on when on basis, and the volatility of demand comes is absolutely differentiated at different point of the day. Probably in the evening in a restaurant, probably it is very rush. Early in the morning in the restaurant, there are hardly any people into it. Similarly, for weekends, the hotels would be completely chock-a-block. Probably in the weekdays, that might not be the case scenario. So degree of volatility of demand is we need to take into consideration. Let me give you an example of processing time requirement. Let us have a standard product, absolutely a standard product 1 and product 2, product 3. So annual demand is 400 into cost, that is $5 probably, or 5 hours as a processing time. So 5 into 400, annual demand will be looking into 2000 hours, right? Similarly for product 3, but the standard processing time is way much higher, that is 2400. On the other hand, the demand is very high for the third product, and the processing time is also very low. So what are we doing to do together? We add up all together, it comes around to 5800 hours. So that is what we are looking into: a small firm, a medium sized firm, or a large, as in what about it. Now, if we can plot it onto the examples on the graph, If you look at it, BC stands for variable cost and FC stands for fixed cost. Now this is fixed cost. Remember, this is fixed cost. Am I clear? And similarly, this is what I will say is my variable cost. This is my variable cost. And this adds up. B plus VC plus FC becomes my total cost. Now this is my TC, the total cost. Now if you look into it, it is the number of product which has been produced out here in the x-axis and the amount that has been spent. When we are initiating, there are nothing, no fixed cost is zero. But moment we start initiate, we start out here with a fixed cost which is way back higher. Why so? Because this is what the rentals might be incurred upon it, electricity, agreement, raw material. So this is my fixed cost that goes around it. But as we start producing it, the variable cost increases, right? And it increases over a period of time. Till this moment, if you look into it, the fixed variable cost is less than the fixed cost. But beyond this thing, the variable cost enhances. And similarly, the graph for the total graph will also be enhanced, plotted accordingly there. So what are we looking into it? We are looking at a total revenue. So fixed cost plus variable cost and the sale that comes up to us because of those businesses that we are into it. There comes the revenue. Let me bring in the new concept for you to understand is the BEP or the break-even point or break-even analysis. Now, if you look into it, the fixed cost, I have been giving you the example out the fixed cost, right? This was an fixed total cost, sorry. This is your total cost that comes, which goes around it. Remember, the volumes is have been plotted on x-axis and the amounts have been plotted on y-axis. Now, the revenue, the sale increases. Look, initially there are no sales. In fact, this period there is no sale. After it, the sale increases, but at this point of time, the amount of revenue and amount of cost are almost equal. This is the point that goes around it that defines it. So beyond this point, everything is profit. So these are my profit. These are my profit that been taken into account. So please understand the quantity multiplied by the contribution to the margin minus fixed cost is what we are looking into. Quantity, revenue, and the variable cost minus fixed cost is your profitability or the break-even analysis. This, beyond this, the business is all sustainable, all successful, and profitable for you to carry it. Now, similarly for break-even problem with a multiple fixed cost, what we are looking into it, look what needs to be understood is every time there is a circle, this is what I am trying to do is my fixed cost altogether. For every time I involve into it, the third quantity, the fourth quantity, the third machine, the fourth machine, there is a fixed cost. Let's say the cost of the machine itself is the fixed cost around here. So every time I enhance my capacity, my things goes higher and higher and higher. So fixed cost and variable cost, thick lines needs to be understood every now and then. But then the revenue, you look, this is my revenue things. This is what my TR is all about it. Total revenue is telling me the brown color. It crosses number of times. Out in the first variety, it doesn't cross. But then there is a cross out here and there is a cross out here. So first, with the first machine, I am making or establishing myself within the market, but I am not profitable. By the time I have installed my second machine, probably I've just touched the profitability factor or crossed the profitability factor, but not sufficient enough. Now what do? I bring in the third machine and look at it. My profitability then starts zooming around it. So this is what we are looking into it. In the first machine, there are no break-even points. Absolutely. This tells me how do we plan the capacity. Capacity planning is what we are all entail into, and that is the reason why I have introduced the term about break-even analysis, the fixed cost, the variable cost, and so on and so forth. So remember, cost volume, or should I say break-even analysis, is all about the level of production that equates with the cost or the total cost of revenue. We have taken a very fundamental assumption as in just one product. Essentially, this might not be the cases. There might be multiple products. Everything produced can be sold. Again, this is not an ideal situation. In fact, some of them gets left around it. Variable cost per unit is same with the volume. Probably not the case scenario. It's theoretically yes, but practically not done there. Fixed costs do not change with the volume. Yes, they change, but they change a little bit. For example, you hire more manpower, so salaries are variable cost, but the number of heads becomes much more pertinent. Revenue per unit constant with the volume. Again, since you are having changing with the quantities of the machine or the manpower, things get changed. What I've discussed with you is an ideal situation at a laboratory setup. You work around it, but this is for your understanding and very much practical if you can implement with a sense of a direction and understanding thereby. So, in order to have a capacity planning, I would love to summarize with the types what we are looking into it, what kind of capacity that we are looking, what term. In terms of duration capacity we are looking into it, what are the utilizations efficiency as per 100%, actual utilization, pertinent utilization, things like that, which we have already elaborated upon it. And the last concept was all about your break-even analysis in this thing. With this, I come to an end of capacity planning as a presentation. I hope all of you have understand the concept that have been brought in and introduced to you, so that it enables you to equip yourself for planning capacity in your own way, in your own organization. Thank you for watching this video.